Zach has been working at the intersection of real estate and venture capital for the past decade. He's the most active early-stage Proptech investor in the US, having funded over 60 startups in the space as an individual, as well as 40 startups and counting through Metapop, New York City venture capital funds. In addition, Zach's worked on large-scale mixed-use development projects in cities including Boston and LA with Millennium Partners. He's a professor of Proptech at Columbia and the author of a book, Proptech 101, Turning Chaos into Cash Through Real Estate Innovation. Thank you, Zach.
Thank you. Thanks for having me.
Sure. Before we got on stage, Zach and I were talking in the green room, and he said that a few years ago, he was knocking on doors and basically scratching at every opportunity to get on a stage, and now he's, being asked all the time to speak about Proptech. Zach, why is that?
Well, it turns out that in order to stay relevant in the real estate business, even when times are good, and especially when times get bad, it behooves everybody to embrace a culture of open innovation, embrace a culture of willingness to fail, embrace a culture of technology adoption and efficiency creation, not for the sake of it, but to really evolve the entire culture of a firm in the direction to skate to where the puck's going. So I think it's been a gradual and now accelerating trend we're seeing in the industry is just more and more adoption. The adoption's accelerating. Something my friend Chris Kelly said at this panel I was just telling you about at Wharton last week was the pace of innovation in Proptech is never moving more slowly than it did today. So this is today, and what is it, May 15th, 16th, 2019. This is the slowest that Proptech will move for the rest of your lives. So we are doubling down on acceleration of innovation, and we're very, very excited that the industry seems to have woken up to it. But just to give a little plug for this woman over here and The Real Deal, when we started the company in 2015, there were so many issues there's so many holes we were trying to plug in the ecosystem. One of the issues was that the entrepreneurs we were dealing with, not only did they not know how to talk to the press, they didn't even know that the real estate had its own press world that played by its own rules, that had its own gatekeepers, its own industry trade rags, and EB lent her time just because she's a good person and because she saw this vision early on. She lent her time and came and spent it with some of our startups and talked to them about how you work the press, how you create stories, how you create buzz. And that's a huge part of our practice here at Metaprop. And so I just wanted to thank you for that. I don't know if I've ever properly thanked you for that, but there were a handful of people early on when we were starting the business in 2015 that were really leaning in, and they always have a big place in my heart.
I actually forgot about that until now. And I remember at the time I talked with the founders about funding and raising funding and how that sort of was instantly news. And since then, there's been so much money raised. I was reading a CRE tech report that said last year $9.6 billion was invested in Proptech companies. But I wanted to ask you about that number because according to that report, the $9.6 billion was actually a 23% drop. So I wanted to just ask you, what does that mean? What is that all about?
Yeah, in my space where we play, which is really, really early stage companies, we try to ignore the headline and follow the trend line, or we're trying to ignore the noise and follow the signal. So there's a lot of disagreement, I would say, and we devote a whole chapter in Proptech 101 to the taxonomy of Proptech. And the reason we're so anal retentive about it is because there is no taxonomy that everybody agrees upon. So because there's no taxonomy that everyone agrees upon, there's no consensus on which financing should be included in that $9.6 billion and which financing shouldn't. So there's a lot of differing data out there that suggests that funding was just as robust in 18 as it was in 17. We also in 17 had some mega, SoftBank skews the whole market. So if you're including SoftBank, where they seem to be putting $1 billion a week into something PropTech related, do you discount them? Do you include them? Do you include them so for us, our focus, which has always been at the early stage of company formation and just after, we're seeing companies get funded at a faster clip. We're seeing more and more participants in the ecosystem. We are seeing ourselves battling harder and harder to secure allocations in the deals we're looking at. So we see, so those numbers, while they're important for general trends in the industry, you have to be careful with seeing a number and saying, oh, that is indicative of the industry, because SoftBank can come out tomorrow and announce a $10 billion financing round in company X. And if that's a PropTech company, that will significantly skew 19 relative to 20 if that doesn't happen again in 2020. So you gotta, it's very tough. What I look at also when I look at the numbers is I look at PropTech investment relative to FinTech venture capital investment, and that's tough to measure as well, but we're somewhere between 10 to 20% of overall dollars going into FinTech. And if you look at global real estate, again, tough to quantify. I hear 15 trillion, I hear 30 trillion. If you look at that being the biggest industry in the world, it would suggest that even if there's a nominal decline year over year, there's still a huge amount of room to run. And people ask me all the time, they say, well, what inning are we in the PropTech evolution? And I say, well, there are certain subsectors that we look at Metaprop where we're not even, forget inning, like we haven't even gotten to the stadium. Like we're like tailgating outside the stadium right now.
So like what sector or what industry would that be? Gotten a lot of attention.
One sector is like construction automation. Like we are still, despite the incredible advancements in the space, whether that be excavators that can drive themselves, or machines that can lay bricks, or printers that can print buildings. I mean, we've done a lot. Like, let's pat ourselves on the back a little bit, but we're not even scratching the surface of what those machines can do. So that's one sort of category. And then there are quite a few others that relate to modular and prefabricated housing as well. Material sciences, there's a whole opportunity for venture capitalists to invest in the building materials of tomorrow. We haven't even scratched the surface on that stuff yet. But then there's still like very basic broken workflows that can be fixed with like really good software. We like to invest in that stuff too, and we're still pretty early in that, right? Like, let's look at VTS. VTS is now a semi-mature company in our space. They just raised money at $1 billion valuation, which is awesome for them and for the industry. But if you look at their market, and they have 10 billion square feet on the platform, super impressive. But what's 10 billion square feet represent in terms of market share? It's a drop in the bucket. So, we are still very, very early in the industry's adoption of basic software systems like a VTS, and even earlier in their adoption of highly complex robotic solutions.
So you mentioned VTS, but I want to back up, since we're not at the total beginning of the PropTech evolution. What are who are some of the big winners so far? Certainly there are some companies, startups that have cashed out, that have exited and are public, and there are some successful private ones.
Yeah, so if you go to our office, PropTech Place, which is the spot if you want to talk PropTech, you will see as soon as you walk in something I did with my TA this year at Columbia. It's the history of PropTech, and it's a timeline, and we have visuals, every innovation. First innovation is the invention of the tent. That happened in 12,000 BC, followed by the fire clay brick. That was 4,000 BC. Then we ramp up to modern era. We actually just learned, we're going to redo it, the first prefabricated home was shipped across the Atlantic Ocean in 1670. That's going on there. Anyway, so I talk a lot about prefabricated housing, modular housing. You had, affordable housing titans coming up here, right? Ron Moelis was up here. Like, this is not new stuff. This is new technological tweaks on old stuff. But anyway, some of the successes, I mean, the first big success in Proptech going back, if you're not tongue-in-cheek, like, I studied ancient history in college, so I geek out on this stuff, but in the modern world, it was J.D. Edwards. J.D. Edwards was the first ever sort of heavyweight enterprise accounting ERP. That really launched in the 70s, followed by platforms like Argus, which really transformed the industry. The first sort of big success stories, J.D. Edwards' IPO was sort of a watershed moment. CoStar's IPO, CoStar's acquisition of LoopNet. CoStar, talk about market share. CoStar, the reason the public market assigns such a high value, multiple still to CoStar is because of the same thing with VTS. Even though they are a $18 billion company, there's still so much room to run. They still have such a low market penetration. But anyway, CoStar's acquisition of LoopNet, I would say the IPOs and then merger of Zillow and Trulia. And then I would say some of none of them have IPO'd yet, but I would say the disruptive financing rounds of some of the private large companies like Airbnb and WeWork have been sort of big events in the relatively short history of our space.
What's the metric you use? Because sometimes I look at lists of Proptech companies that have gone public, and I look at their valuations, and then I look at the valuations that investors assign to private companies, and I see that they're worlds apart, and it is completely confounding to me.
Yeah, so part of what happens in private markets that doesn't happen in public, there's a couple differences between private markets and public markets. The major difference is liquidity. So this is obvious, but in publicly traded companies, your liquidity is much higher, and there's much more information about that particular company, and it's theoretically an efficient market. In a private market, private company, you have information arbitrage, theoretically. You have a limited amount of capital that the entrepreneurs are willing to sell, and a lot of capital that is mandated to go into it. So you have sort of excess supply for minimal pent-up demand, which pushes up valuations unnaturally. The other aspect of unnaturally high private market valuations relates to the terms that a private market investor can demand that a public market investor cannot. So there are certain clauses in a private market financing that you often see at these later stages that are ratchets, anti-dilution provisions, liquidation preferences, things where the downside of the investment is protected, and so an investor might be willing to give up on the front end, on the upside, and say, okay, I'll give you $1 billion valuation, but I know that I'm still going to get my money back. Whereas if I'm buying common equity in a public company, if that gets, I'm now sort of in the liquidation stack with everybody else. So that's a reason, those are two reasons why private market valuations tend to be higher. When investors try to liquidate on the private markets, what you see more of in reality is you see them when liquidity is there. Sometimes there's just no liquidity. But when liquidity is there, it's usually liquidity that's coming at a discount to the most recent headline valuation.
Okay. So I don't know if this is going to be a naive question, controversial or what, but with all of the money floating around, do you think that there are startups out there that are being funded and maybe they're not deserving of all the funding, or maybe are good companies getting more funding than is prudent?
Yeah, I mean, look, we as VCs worry constantly about overcapitalizing our own companies, and then also overcapitalization of companies just across the board. I think that when you overcapitalize a company before they've truly found product market fit, it can be catastrophic for that company, and it can kill a company. And I'm not going to name names, but I've seen it happen to companies earlier in my career, before we had Metaprop and we had all our reputation and our heft. And when I would now say to an entrepreneur, you know, you're really overcapitalizing, and they say, they may not agree with me, but they actually, you know, 10 years ago, I was just an ordinary bloke saying they were overcapitalizing. And I've seen venture capitalists sort of rush sales, distribution, biz dev, marketing before hitting product market fit and crushing companies, and then the companies run out of money, but everyone's pushing them to spend the money. So it creates this like vicious cycle for the entrepreneur. They can't raise money from outside investors because they have no traction. But the reason they're having no traction is because their current investors have been forcing them to spend money prior to finding product market fit.
So is that one of the most common mistakes that a founder can make, or is there something else that you think is a common mistake that you see over and over?
You know, I don't have a list of all there's so many that people make all the time. I would say throwing money at marketing and sales before you have an inkling of product market fit is one of the top 5 biggest mistakes a startup entrepreneur can do, 100%.
So this is kind of along the same lines. A number of startups that have raised significant money have gone south. They've failed. Realty Shares comes to mind. Purple Bricks on the residential front is not failing, but it's pulling back, certainly. And I'm curious, what are some takeaways? I don't know if they're case specific or if
Yeah, well, I mean, I can talk about Realty Shares. I was the second investor in that company. I then went on to finance both founders' companies after, so it shows you that failure can be an asset to an entrepreneur as long as they learn the mistakes they made. And I think the fact that both founders have been able to successfully start new ventures shows that, one, they're, you know, people of character and integrity, and two, that they've learned from their mistakes and are humble about it. But I think one of the issues with Realty Shares, and I wasn't, you know, I was just an angel investor, really small amount of money, I didn't have any information. You know, at Metaprop, it's very different. We're heavily involved. We have information rights. I'm sometimes sitting on the board or a board observer. It's a different kind of thing. So I have a lot more intel into what goes wrong. But I think what happened, and I'd love to see someone run this analysis, there's a concept in venture of crossing the chasm. And that means that, and there's also a concept called the treacherous B, which is the Series B round is known as the treacherous B. And that's because when a company gets to a Series B, they're typically gotten to a Series B because they've displayed an enormous amount of traction very quickly. It is the job of the venture capital investor in the treacherous B to say, is this something where the prior traction is going to demonstrate that they're going to cross the chasm and become the next Facebook? Or is this going to be a niche product forever, and I'm essentially pouring gasoline on a fire that's just puttering? And by the way, could putter on forever and be a great business, but is not going to be a high-growth venture capital business, okay? David C., who's an investor at Greylock, I don't know if he's retired now, he did Facebook's Series B, treacherous B, at a $500 million pre-money valuation. And legend has it, he almost lost his job because all his partners were like, this is so crazy. But in hindsight, getting into Facebook at a $500 million valuation is brilliant. So here's what happened with Realty Shares in that context. Facebook was able to cross the chasm. Realty Shares launched and had as did many of the crowdfunding platforms, And they had a really interesting value prop to the market, although a complex and highly regulated and highly sort of paperwork-heavy one. And they got really good initial traction because there was a pent-up demand, mainly of Silicon Valley type people who had made a lot of money tied to the equity appreciation of their stock. Like, let's say you worked at Apple during that period. These people had money to invest, were interested in diversifying into real estate, and they were the ideal customers for the initial crowdfunding sites. And so through seed and Series A, the crowdfunding adoption was off the charts. I mean, these companies were growing like crazy. And when you're growing like crazy, it's very hard to set up infrastructure that you're going to want for later on. Technological infrastructure, business infrastructure, et cetera, especially when VCs are saying go, 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 grow, 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 right? The treacherous B happens, okay, to all these companies, Realty Shares just being one of many. And there's great traction, but it's traction from a very specific type of customer. Now, around that time, what also starts to happen is these people get tired and poor. Not poor in like in a real way, but they feel poor because they've spent their real estate allocation already, and these are not titans of industry. These are people probably making a couple of $100,000 a year who maybe have $40,000 lying around to invest in a crowdfunding site. That dries up. You do 4 or 5 deals, you don't necessarily have an appetite to do more. So all these platforms say, okay, we're going to break out of that. And they can't. There's no customer. So what do you have to do? You have to go up market, and you have to target the institutions. But what do you need to target the institutions? You need the infrastructure that you hadn't been setting up because you were just growing so gosh darn fast that you couldn't set it up. So you now find yourself in a place where you don't have the infrastructure to service the institutions, and you don't have the customers to service the demand for the real estate. So it's very analogous to what happens, although in fintech there were better outcomes, what happened to the P2P lenders. So Lending Club, OnDeck, all these platforms in the private markets, they were being valued like tech companies. They IPO, and all of a sudden they start getting valued like lenders. They start getting valued relative to book instead of relative to, you know, revenue. And their stocks all crater once they hit the public markets. Now, fortunately for those seed investors, they were able to go public and probably provide liquidity events to the super early people, whereas the crowdfunding companies kind of all tripped up at this same stage, Series C-ish stage, because no one understood the dynamics that they weren't going to be able to cross the chasm. So it's not necessarily a problem that was exclusive to Realty Shares. It was a problem of the industry that no one really was able to foresee.
So when you talk about crossing the chasm and you talk about grow, 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 one word that you haven't mentioned yet in 20 minutes is profitability. And, you know, I think we can
What is that?
But I mean, really, I want to talk about it. It's not unique to Proptech, but it's a phenomenon that exists in Proptech, where you have companies that are growing, they're enormous, they have enormous astronomical valuations, but they lose a tremendous amount of money. So I guess the question is, do investors know something that the rest of us don't? Is it concerning that they're just losing money and that seems to be okay?
I think investors in both the public markets and the private markets seem to be highly tolerant of companies willing to lose money as long as they can show a long-term path to profitability. And there's no better example of that than Amazon, which didn't turn a profit for decades of existence as a public company. Now, Amazon is not a Proptech company, although they are now building houses that are wired up with Alexa so they can completely control your lives. So good luck with that, everybody. But if the market was able to tolerate Amazon, because Amazon always showed a glimmer of flip the switch, slow the growth, become profitable, I think there's a high tolerance for it. I think what the market in a down market is less tolerant of is companies that show immense growth, no profitability, and no glimmer of we could flip a switch and become profitable, where there are actual doubts fundamentally about the business model. But there are, at least in the public markets, and even the private markets too, some highly profitable Proptech companies. I mean, Yardi, it's a private company, highly profitable. Argus, which is a public company, is a highly profitable company. There are many, it's just, they don't, the ones that get the headlines in your newspapers are the ones that don't make any money and raise billions of dollars in order to, plug that gap and go for breakneck growth, But there is a way, I mean, they're not public, so I don't know if they're private equity owned, so I don't know if they're profitable or not, but I would imagine they are. MRI, I just saw grew revenue like 50% year over year last year. And, some of that was through acquisition and some of that was through organic growth. But I would imagine because it's private equity owned that MRI is a profitable company. And if you're able to achieve that level of growth and maintain profitability, that's pretty good. But then I guess what does it say about the companies that aren't able to become profitable? Look, I don't know. I'm not smart enough to know how it all shakes out when things finally start going bad, if that's like ever going to happen. I know we've seen like glimmers of things, but I don't really know. I would not want to be a seed stage investor who theoretically has the option to exit before that has to be found out, and exit for, by the way, 100x. I would rather have that opportunity and then everyone's like, oh, Zach, you invested in this company. It never became profitable. Sorry. It's like, yeah, but I made my investors 100x. So like, I'm sorry for you that like you weren't one. You know what I mean? Like, I don't know how to reconcile that in my brain.
Just given all the money that's flowing in, where are we now in terms of exit strategies? Is there an overarching trend now in terms of companies looking to IPO versus do an M&A deal? Where are things going?
It's the IPO markets are wide open right now. The IPO markets are also really jittery. So, I haven't been in the business for that long. I was still in high school at the big last peak. So I don't know exactly how it shakes out when the IPO market completely dries up, but I've been through some periods of IPO market being completely dry. This is a wide open IPO market that can change on a dime, so could close up fast. So more and more companies are being encouraged to IPO. On the M&A front, what's super exciting for us is the companies that always bought, the Real Pages of the world, the CoStars of the world, they've ramped up their acquisitions. So like Appfolio, is becoming more acquisitive, and as those companies get bigger, they acquire more. So we have the PropTech incumbents looking to acquire. You have the advisory firms looking to acquire, JLLs, your Cushmans, your CBREs. They're acquiring tech more voraciously than ever before. You're seeing the equipment manufacturers, the BMS, the Siemens of the world, starting to buy into PropTech businesses, like Siemens buying Comfy or Johnson Controls. Johnson Controls, Siemens getting involved in that. And then you're also seeing big players like Oracle, Google. That's super exciting for us. They're starting to buy companies. So we're seeing a lot of potential M&A opportunities. And on the private equity side, 10X got taken out for $1 billion. That was a private equity fund selling to another private equity fund. You would have never seen that 10 years ago. So there's like 5 or 6 different exit channels for my companies that didn't exist 10 years ago. So I'm pretty psyched about that. We run out of time.
Before we wrap up, I don't even know if we have time for this, but I want to open it up. Does anyone here have any questions that they want to throw to Zach?
Yeah, I mean, we have it. Yeah, look, we look at every asset type which is different in real estate. So the technology an office building might need is different than what a multifamily building might need. It's different than what a single family home might need, different than what a warehouse might need. And then we look at dirt to disposition of an asset, every single process that has to happen, and every person that touches a choke point in that process. So we're gonna look at appraisal being one choke point. And we're gonna say, okay, the way you appraise an office building is different than a single family home. And there are two ways to fix appraisal. One is creating technology that enables appraisers to do their job faster, better, cheaper. And the other would be to replace human appraisers with some AVM, right? At Metaprop, we want to find the best team looking to disrupt appraisal from both angles. We want to back them both, and then we want to back them for a different asset class. So I'll give you an example. So we saw a company called House Canary starting to see some success in single-family home appraisal. We said this is going to move into multifamily. So we found a company trying initially to do automated valuation for appraisal. We worked with them. They ultimately pivoted into becoming a tech-enabled appraiser themselves. So they're actually not saying a robot's doing your appraisal. It's still a human being. They just use the software and they're more efficient. And so that's an example. That company's called Bowery Valuation. They're based here in New York. That's an example of us funding a tech-enabled business as opposed to a software-as-a-service business or a piece of technology that's looking to replace what's typically done by a human being. We've done all of them. We invest. So that's how we look at little subsectors, and we go really, really deep into each subsector where there's really significant pain, and we look for teams that are solving that pain in a variety of different ways, and we are not smart enough to know which means will come to the end, but we know that the end is ultimately more efficiency amongst all these processes. So that could be appraisal, that could be surveying, that could be construction, that could be design, that could be financing, that could be anything. Anything in a real estate process, yes?
Zach, everybody's talking about, he's bringing up again, Zillow and Redfin, but it's so pervasive, and Open Doors, the private company that's getting funding, and they're throwing hundreds of millions of dollars. And yet you can listen to Redfin and Zillow's conference call last week, both of them, online, and see that they're bleeding losses and buying real estate that's an illiquid asset, that's cyclical, and raising money and making little spreads. 1%, fix and flip, doing renos. How do you see that working out? Is it just a bleeder forever, or do they really disrupt the residential real estate market?
The iBuyer market? Yeah, I think if you're able to, I think what's happening now in the iBuyer market is everything is converging, and Open Door is starting to. Open Door, when they launched, was totally cut out the brokers. Now that Zillow's launched their iBuyer platform, Open Door bought a brokerage, Open Listings, and they're now cozying up to brokers deliberately. So Open Door is starting to look more like Zillow, which is starting to look more like Redfin, and Redfin's looking like. So unfortunately, in the future, I think all of these players are going to try to simultaneously run businesses that basically compete with each other. One is enabling agents and brokers to advertise and making money through that, which, by the way, if you can achieve their scale, I think can ultimately be profitable. Two would be being a broker, so brokering deals on residential transactions. And three would be disintermediating the broker, buying the house and putting it on balance sheet. You know, the world has never seen what happens with iBuyers in a down market. So I don't know what will happen. I am curious to see what will happen. I'm not going to make any bold prediction on what will happen. I think what's challenging if you're in the space as someone who advertises on Zillow or a broker at Redfin or like someone who works at Open Door, you've got to be thinking like, what is going on, and like how are all of these companies going to be able to do all of these things that seemingly are like biting the hands that feed each other? And I don't have a great solution to that other than trying to stay out of it and being friends with like as many people at those firms as I can. Yeah, in the back.
Hi, Zach.
Hey.
So Metaprop has some amazing partners. It's you as well and another partner.
Yeah, look, I mean, I don't know about closing a deal. It's more in sourcing. I had an issue as a transaction professional in a commercial real estate context. I had an issue with an Alta survey. Has anyone here had an issue with an Alta survey? Everybody? I don't know. And I was like, there's got to be a better way to do this digitally. And I hunted around for 2 years, and I found this crackerjack team out of MIT doing it. And I was super excited to fund them. And so a VC who hadn't had that on-the-job pain, where like I almost lost this deal because there was some encumbrance that wasn't on the Alta survey but was in the title report, like, yeah, I wouldn't have seen that. In terms of closing, I mean, I'm fighting like a dog for allocations. I'm doing whatever I can. I put, does anybody know the song Country Grammar by Nelly? Yeah, so when he goes, let me in now, let me in now. So I played that for an entrepreneur who's not letting me into his round, and he still didn't let me into his round. So if I have to play Nelly and I can't get in, you know, it shows it's a hot competitive space. But look, how I hustle to get entrepreneurs to like me is I'm just straight up with them. From the minute I meet them, I say you can skip to slide 5. I don't need to hear that real estate's a big market. Thank you very much. Like, skip to slide 5. And they're like, really? Even still. I mean, back then, in like 2011, the skip to slide 5 thing was so powerful. Now it's like less powerful because Proptech is like a thing. But just being straight up with people, saying the tough things that most VCs are too scared to say because they're scared of torching their reputation. They're scared entrepreneurs are gonna say, oh, don't work with this person. Look, it's, you know, it's not fun coming in there and pitching me and getting the wind taken out of you, but if you're willing to work with me and put the time in, we can maybe build something. And that level of transparency is unfortunately lacking in many parts of the VC world, and the kind of, you know, tough talk that a New York real estate person brings is a breath of fresh air for a lot of these entrepreneurs. There was one more question in the back and then up front, and then I think we gotta, yeah. Yeah, I mean, that we don't have time for that one, but the short answer is we are investing in blockchain companies. The long answer is we do not believe, and if anyone's read it, so Daniel Fettner and Ryan Friedman of Corrigan wrote in PropMoto about 2 months ago. It was sort of the definitive white paper on crypto and real estate. And they sort of concluded that it's interesting, but it's too early for a lot of the transactional stuff. But it's sort of inevitable for that stuff, but it's not happening yet. What is happening is blockchain is having deep impacts on the supply chain. And so you're increasingly seeing supply chain type companies that have to manage disparate global supply chains turning to blockchain solutions to help them manage those more efficiently. And so we backed a company that's doing that on the construction side. It's called Brick. They're based out of Santa Barbara, California. And so it's blockchain, and that's a cool thing about it for sure. But the magic comes from the database, the data and the database itself. And if it weren't on the blockchain, it could exist on in an Oracle database and still provide value to the customers. So we also believe blockchain can have an impact in the escrow process, and we made an investment in a company doing that. But that we see as a much longer term development, like, you know, and potentially such a long term that we still could be too early for it. Yeah. All right. I think one more question, then we got to. Yeah, I think so. I think if you want to start a solution for a problem that doesn't exist, I think tokenization is a great idea. I think tokenization is the easiest thing to default to if you haven't identified a real problem in real estate, is to start a real estate tokenization company. It's super easy to do. It requires no creativity. It doesn't work. and you're not solving problems for anybody who's in the real estate industry. Those are my 4 opinions on tokenization.
I didn't hear an opinion in there at all.
What? Anyway, thanks everybody for having me.
Thank you so
I really
much.
appreciate it.
Thanks for coming.